Hello, thank you for joining me to this meeting. Today we want to learn about liquidity and what is liquidity. So liquidity is defined by the stop losses that are in the market, that are placed in the market, and there's liquidity. And this liquidity are the stop losses of the orders that are in the market. So this liquidity will be looked at by the market to be inactivated or to be stopped. The stop losses has to be stopped so that the market gets enough fuel to move on. The smart money needs to activate the stop loss of the system orders in the market so that they can place their positions in the market. And how is this possible? Let's say you are in a buy order and you have placed a stop loss, or you're in a sell order and has placed a stop loss. Whenever your stop loss is hit, you are engineering liquidity to the market, or you are contributing to the liquidity that is being added to the market. Now, there are some areas where majority of the traders are placing their positions. And those areas where majority of the traders are placing their positions are areas where the market maker will be interested in to place their orders there. Because if there's an area where there are majority of the people are buying, and this majority are 80% and the minority are 20%, which direction is likely the price to go to? The price will go to the minority direction, because if they'll go to the majority direction, 80%, they'll have to give out 80% of their money to the people. But if they go against this 80%, they are going to take the 80% out of the pocket from the people who are buying. So that is how they do. They always look at the overall positions of orders that are sitting in the market, overall areas where majority of the orders are being placed, and the market will be always looking to enter to the opposite directions of where majority of the people are placing their orders in. Now, liquidity also is being accelerated, or is being done also by this bank, because the bank are the ones who are able to manipulate the prices. If you can remember, when we were doing participants in the forex market, we talked about the bank being able to manipulate the prices. Okay, and now this bank will be manipulating these prices so that for the sake of liquidity only. So we have said liquidity is found where stop losses are also found. When we look at the types of liquidity, we have two types of liquidity that includes the buy stop liquidity and sell stop liquidity. Also, another name for these liquidities are, for the buy stop, we also call it buy side liquidity, and for the sell stop, we also call it sell side liquidity. All mean the same thing. Okay, we are going to look at one example of the buy stops liquidities, and the other example will be done by you. Okay, so for the buy stop liquidity, it is originated by the stop losses of the sell orders being activated. The stop losses of the sell orders being activated. Okay, so the market reversed the downside because bank uses the BSL to place sell orders in the market, and we are going to look at these examples here. Now, areas where we'll be focusing on to find the liquidity, areas we'll be focusing on to find this liquidity will be including the previous monthly high, previous weekly high, previous daily high, high of the day, and old highs. Okay, so those are areas we'll be looking on to find where we are this liquidity sitting, where majority of this liquidity placed. Okay, now there's this example. So let's say these are markets. The market is going from higher low to higher high. Then from this higher high, the market gave us this higher low. Then from that higher low, the market also gave us this higher high. Okay. Now, if majority of the people were, most of the people will be seeing this line here. And we have two types of traders. Majority of the traders are traders who trade support and resistance, and these are resistance line. So with this type of people, whenever the price is at the resistance, these are resistance line. Whenever the price is at the resistance, majority of the traders will be looking to place sell orders. We'll be looking to place sell orders. So we'll be seeing sell orders here. We'll be seeing majority of the orders being sell orders here. Now, with this majority of these sell orders being placed here, what will be happening? Remember, these people who are selling, they will be placing their stop losses here. They'll be placing their stop losses around this place. This is the area where they'll be placing the majority of their stop losses. And this is where they'll be entering sell orders. But what happens if the market goes away from where their stop loss is? These people, they will be hit out of the market. They will be removed out of that market. So whenever these people are removed out of this market, the market will have gotten what? Liquidity. The market will have gotten liquidity. And now, since the market has went to this high, what will happen also to most of the traders who are called the breakout traders? When somebody has seen the price has really rallied up, they will think that the market is buying, and they are going to place sell orders. That's what they are going to place buy orders. So most of the people also will start doing what? They start placing buy orders. So they are going to place also buy orders here, and their stop loss will be sitting below here around this area. This majority of the stop loss will be sitting. So since that is the case, we have eliminated the sellers completely, and now we are having buyers. So these buyers, they will have also to be eliminated from the market, and the price will just come down and hit their stop losses. When their stop loss is hit, these buyers have exited their position, and even some will have exited their position net negative, complete negative, or some will have lost 50% of their capital, some 100% of their capital. It depends on their trading conditions. Okay, so you have sell and buy orders here. You have entered the sell orders and whatever. So the market will have gotten liquidity from the buy and from the sell orders. That will be liquidity. And now we'll be expecting to do what? To see price rallying down. So this can happen when you are focusing on the monthly time frame. It can happen when you are focusing on the weekly time frame. It can also happen when you are focusing on the daily time frame, and any other time that you will be focusing on. This will be able to happen. Okay, so I'm going to look at this. Just a minute. Now this happened with my machine. Okay. Okay. This is it. So this is the previous monthly high, previous weekly high, previous daily high, or the high of the day. It can work. Now look. So we had said some people will be buying here, and also some people will be selling. The sellers will be sitting below this area, and they'll be placing their stop loss above this high. And also, so some people will be placing their stop losses here. They'll place their stop loss here. Sorry, my screen failed to share. I don't know what happened. Yes, that's now correct. Sorry, my screen went blank. I've tried to reset it and it failed. I hope now you are able to see my chat. Okay. Since you are able to, then that is good. So we were saying this is the previous, either this can be previous monthly high or any other high that will be existing in the market. And we will say that some people will be buying here. Whenever this high is broken, they will be buying here, thinking that the market has broken and it is now going high. But what happened? The price will only be just be looking to manipulate them. Okay, and the price went down to this low. So any areas like this would be focusing, will be calling it buy side liquidities. Okay, so liquidities that are taken when the market is trying to manipulate the buyers. Even the same case as this equal highs, look, these are equal high, then the market went down, and then it went up, rallying up. So remember, most of the people who are support and resistance traders, they will be selling here, and their stop loss will be activated. Also remember, there will be breakout traders who will be thinking that the market has broken out of the resistance, and those they'll be what? They'll be buying these positions. So whenever these orders are there, they will place their stop losses below for the buy and the stop loss above for the sell. So whenever that happens and this stop loss is hit, the market will again have liquidity to move. Okay. So this is an example. This is an example also for the weekly time frame. This is the previous week, like for this one. This previous week high. So from this previous week high, the next week, the market opened here and it went to manipulate those previous week high, take note the buy side liquidity, and then the market went down. Okay. The same, this one is the previous weekly high. This was the previous weekly high. The market went up, manipulating those high, and it went down. Okay. So it's happened like this. Previous week high, then the BSL is taken and the market reverses direction. Okay. Example here, previous daily high. This is the previous day, and this is a new day. The BSL is taken from that high. Previous day, that high is taken, and the market went down. Previous day, that high is taken, and the market went down. Okay, and this is also high of that day, high of that particular of a certain day. From that high of that day, the market went to this high, this low. Then when it was going to this high, it clears liquidity from the high of that day, creating a new high and clearing what? Liquidity. Remember, some people will be buying whenever they see price has gone away from this previous high. So when these people are buying away, the price will just enter that zone very fast and comes out of that zone very fast. The reason as to why it is doing that is because it wants to rapidly clear people out of the market and continue its move. We want to clear out of the market and continue the move very, very fast. So it's happened very, very fast. So these are old highs. Look at this high. This was a previous, or this was an old high. The market went, cleared the liquidity, and it went down. The same case for sell side liquidity, which we are not going to focus so much on. It happens also at the equal lows, where the equal lows is cleared. Look, this equal lows is cleared. Liquidity is taken. The sell side liquidity is taken, and the market move up. Or the same case, if this was a low, that low liquidity is taken and the market reverses direction. Okay. So I want you to practice more on this. I want you to try to identify where the BSL are and where the SSL are. So when a BSL is taken, the market reverses to the downside. And when a SSL is taken, the market reverses to the upside. So whenever you see those areas, now if the market was going bullish and you have seen BSL or BSL taken, start now to change your mind that the market is now starting to go what? To go bearish. Okay. And the same case applies to the other one. So this is still the BSL, buy side liquidity, and that liquidity is taken. So also liquidity can also be called SH, which means a stop hand. So liquidity just means a stop hand because the market is just looking for stop losses. Like for this case, this is just liquidity. This one is just liquidity being cleared. Okay, the same thing. Market extends, clearing the liquidity, and it moves. Okay. So we are going to touch on the point of interest, POI. And one example of the POI is called the order block. Okay. Order block. So when we say order blocks are candles where market maker bank have placed their position. Generally, the market makers return to those candles and they are never violated. So these order blocks will never be violated by price. At whatever case, this order block will never be violated by price. And there are two types of order block. That is the bullish order block and the bearish order block. So when we say the bullish order block, this is the last bearish candle before the bullish movement that caused a break of the market structure and has the most range between the open to close, or it can also be near a support level. So we are going to look at this scenario. Let me draw this. So that is the market was going down. I'm going to set it color red, bearish. So this is the market going down. Market going down, market going down. So this, let's say here was a lower high and lower high, and these are lower low. So whenever we'll have a sharp move that runs away from this lower low and it caused this lower high to be broken, the last bearish candle, this one, will be called now a bullish order block. So let's see. Let's say the next candle, I want to change this candle. I want to change color to green. Okay, let's say this candle, bullish candle, really open up, went up. The next one starts there, went up. The next one starts there, went up. And because this break of structure, this lower high to be broken. So whenever this lower high is broken, so we'll have a BMS here, break of market structure. So whenever you have gotten this break of market structure, we now know now the market is no longer bearish. The market has now turned to be what? A bullish market structure. And what we'll be expecting? We'll now be expecting the price to continue giving us higher highs. Now, since that is the case, which one will be a bullish order block? Now, the definition we have said, a bullish order block is the last bearish candle before a bullish movement. This bullish movement that causes a break of market structure, this break of market structure. Now, if this is a valid order block, we will know that the price will never come back down to break this order block. It can't, because of what? There are orders sitting here. And these orders are for the big people in the industry. And these orders will never be violated. So if that is the case, the price will not come to violate this law. The price has to come and respect this order block. Okay. So if that will be it, then this will be a bullish order block, the last bearish candle before this bullish movement occurs. And what will be we expecting? We'll be expecting what? We'll be expecting to see this. Let me share another screen. Just a minute. So we have said entry technique: when a price trades higher away from the bullish order block and then returns to the bullish order block, it is best to go what? To go long. So from our charts, from this, now if the price returns back to this order block here, we'll be looking to do what? We'll be looking to place buy orders. We'll be looking to buy here. So we'll be buying at this order block. And our stop loss will be just placed below the low of the order block. So meaning this low here is an area where we are going to place our stop loss. We're going to place our stop loss there. We're going to buy here, and take profit now will be the other side high. This high is where we are going to place our take profit. So this is our SL, this is where we buy, this is our take profit. Let's look at the example. Now, this is a bullish order block. We have seen the market was from lower, low, lower, low, lower, high, lower, low. Then it went high and it broke market structure. This high was broken. So when this high was broken, we have now confirmed that this is another block because it has caused what? A break of market structure. It has caused a break of market structure. Yes. This has caused a break of market structure, and we'll be expecting to see the price retracing to the downside where this order block is, and we'll be buying there, stop loss below the OB, and out the profit above the high. So the bearish candle before the bullish movement that breaks the market structure higher is called a bullish order block. So let's look at this example. The market was going high, low, high, low, high, low, like that. So look, this high, this order block here, this one, the H4 bullish order block break what? The market structure. So when it broke the market structure, we'll be now timing it as a bullish order block, and we will expect to see price respecting that bullish order block. So since it break the market structure, we will expect the price to retrace to the order block, and then we buy. I'm not going to cover the bearish order block, but I will want to show you charts that pertain these order blocks. I'm going to look at the order block. Let's look at this. Look here. So start from the point here. I'm going to go 30 minutes. Now, in these 30 minutes, the market was coming lower low, then to this lower high, then to this lower low, and it went to this higher high. So when the market went to that high high, you can see that this lower high was broken, and now we have a break of market structure here. Is a BMS. We have the break of market structure or break of structure. And now, which other block was responsible for the break of structure? Let's see. It will be this one, the last bearish candle before bullish movement that broke structure. So it will be this other block that broke what? The market structure. Now we'll want to see the price retrace into this other block so that we can buy. But for this case, what happened? Let's see. The price, this price didn't reach this other block. But as we are following, the market went higher high, higher low. This is a higher low, went another higher high, and then it gave us a lower and lower low. So let's see also here. This is where the break of market structure occurred. So that this other block didn't hold, it didn't become an order block anymore because it was broken. So this is the break of structure, break of market structure to the downside, and you will want to see which other block was responsible for the break of market structure, and this one is the other block that was responsible for the break of structure. This. Now we'll want to see the price retracing back to the order block. And like for this case, the price went exactly to where the order block is. So for you, you will have placed your stop loss here above the high of the order block. This could be your stop loss. Let me change the color to red. Stop loss could be here, and we will have entered a sell order here. This will be a sell order, and the targets could now be this low. This is our target is. I will change the target color to be color green. Blue, sorry. So this is now how it happens. This is an order block. This candle is an order block. This is where the stop loss is. And now we are expecting the price to retrace back to the order block so that we can sell. So like for this case, this was a perfect example of the order block. So that this was very perfect. A very perfect example, yeah, order block. I'm also going to show another example here. Even these small areas, and this small area here. Let's see. The market was coming low, high, lower, low, lower, high, then higher, low. This is a higher low, then it went high, high. So this low, this high was broken. Yeah, this high was broken. So we had a break of market structure here, break of structure, and then the last bearish candle before the bullish movement is this. This is the last bearish candle before this bullish movement that caused what? A break of market structure. And this one will be our order block. Let me just find the time frame to 15 minutes. When I refine it to 15 minutes, this will be the last bearish candle before the bullish movement. This one. So when the price does hit this low, you are going to place a buy order. But now let's look, will you be safe for your stop loss if you are using 5 pips stop loss away from that? Let's see if it will be safe. Like for this case, you will not be safe by 2 pips. You will not be safe by 2 pips. Your stop loss could be hit by price here. Okay, so that is how you do the order block. I want you to do more practice on these types of order blocks. Raise your channels through the provided medias, and we will be able to learn more. We'll be able to get more understanding of this market, and I hope you are going to be good traders. Thank you so much for joining. Have a blessed day. Thank you.